This week on the Retirement Quick Tips podcast, I'm sharing with you some interesting and hopefully useful articles I've been reading lately. Today, I'm talking about a recent memo to investors from legendary investor Howard Marks. It's titled very ominously On Bubble Watch. So Howard Marks, he's the co-founder of Oaktree Capital Management. He's probably pretty close to 80 years old. He's been around for decades. He's a billionaire investor. If you follow any of the financial news, you've probably seen him. Actually, one of my favorite personal finance books is called The Most Important Thing: Uncommon Sense for the Thoughtful Investor. Very good book. It's been around a long time. You can easily find it and buy it hardcover, paperback. Anyways, really enjoyed reading that book. And that was my first deep dive into Howard Marks and his thinking. But very experienced, very wealthy investor, has a large following. This particular memo, you can go to the Oaktree Capital Management website and you can find it there. It's very recent. It was just published January 2nd. And it's lengthy. So if you like a long read, if you want to do a deep dive, though, it is excellent. Again, it's long. It's like 10 pages, single spaced. But if you want to understand the psychological forces that underpin market movements, for better or for worse, this is a really great analysis read. He talks historically because he started his career in the Nifty 50, which was in like the 1960s. So he talks about some of the historical things that he's been through the .com bubble when that burst in the late 90s, early 2000. And he subtly introduces how he's talking about bubbles or how he's thinking about bubbles today, sort of building his case. He talks about the 7 top stocks in the S&P 500 today. The Magnificent Seven are Apple, Microsoft, Google, which is Alphabet, Amazon, Nvidia, Meta, which is Facebook, Instagram, and Tesla. He says, I'm sure I don't have to go into detail regarding the performance of these stocks. Everyone's aware of the phenomenon. Suffice it to say that a small number of stocks have dominated the S&P 500 in recent years and have been responsible for a highly disproportionate share of its gains. Anyways, he goes on to talk about how the market capitalization, or the size of the 7 largest companies in the S&P 500, it makes up a third of the index's total capitalization. So you have 500 companies in this index, but because it's market weighted, the largest share goes to the largest companies. And just these 7 companies make up a third of the total index value. It's stunning. He said that that percentage is roughly double what it was 5 years ago. And prior to the emergence of the Magnificent Seven, the highest share for the top 7 stocks over the last 28 years was 22%, not 33% like it is today. So that was 22%. And guess what? That was in 2000 at the height of the .com bubble. Then he goes on to talk about, well, what is a bubble? And he talks about how it is more of a state of mind than something you can define. So he talks about, you have this rapid rise in stock prices. It's sort of this manic, everybody wants to jump in. He uses 4 main criteria to describe it: highly irrational exuberance, outright adoration of the companies or assets, massive fear of being left out or left behind, the FOMO, fear of missing out, and the resulting conviction that for these stocks, there's no price too high. So he says, well, if you're going to say that there's a bubble, those things have to be true. And it's hard to diagnose that, because one of the things that he talks about that makes bubbles so difficult is that if you were going to argue there was a bubble anywhere, you could say maybe it's in a couple areas. It could be in AI, or a lot of these large tech companies that are sort of leading the charge in AI. You could even argue Bitcoin could be in a bubble. Part of the problem with these companies is that it's often accompanied by a new and emerging technology. So there's this newness factor, and it's like, this time is different. It's not a bubble. These companies are going to go up forever because there's this tremendous growth. And that happened certainly in the late 90s and early 2000s before the .com bubble burst. It's like there was all this new technology. The internet is emerging. There was so much excitement. And so people just wanted to like jump on the bandwagon and they didn't want to miss out on that. And you had people who were investing and throwing money at and investing in companies that didn't last. Many of them went bankrupt and they went out of business. And when it happens, the party stops very suddenly. But he says part of the problem with this is that when there's something new, a new technology like AI, there's no history. And then there's nothing to temper enthusiasm because you don't know what the future of that is going to look like. There's always some sort of innovation involved with previous bubbles. And if you were to argue that there was a current bubble, certainly that's happening with AI. But he also goes on to say, most people forget this, that the disruptors or the emerging, the people who are first to the party, who reap the biggest rewards, and what we've seen that with a lot of these big tech companies, the disruptors can be disrupted. You have competitors that come along, you have newer technologies. He talks about how a lot of the biggest companies in the index in the S&P 500 at 2000, so just 25 years ago, were Microsoft, GE, Walmart, Procter & Gamble, Coca-Cola. These companies are still in business, but only 6 of the top 20 that were there 25 years ago are still in the top 20. And I think one of the most important things he says in this is that when there's a bubble, investors treat the leading companies and pay for their stocks as though these companies are sure to remain leaders for decades. And he goes on to talk about why this is, looking at earnings and multiples and stock prices. It's a good analysis, but again, that's getting a little bit into the weeds. But he says, some of them do remain leaders for decades. Like Microsoft is a good example of that because they're one of the companies that was around in 2000, top 20, and they're still around today. But some of them remain competitive and at the top of their game, but many of them don't. And change seems to be more the rule than persistence. So it's funny because he talks a lot, obviously goes on for 10 pages and talks about bubbles, but he doesn't matter-of-factly say that the stocks, the Magnificent Seven, are in a bubble. In fact, he makes some counter arguments. He makes a strong case, he builds it and says, well, look at what's going on right now and look at history and what that says about bubbles. And you can apply some of these things that are consistent across time. If you apply them to the current market environment, what do we see? Well, he says it's not that clear. We could be in a bubble, we could not be. And he says, here are some of the counter arguments for maybe why we're not in a bubble. The PE ratio or price to earnings ratio of the S&P 500 is high, but not insane. The Magnificent Seven are incredible companies, so their high price to earnings ratios could be warranted. He says, I don't hear people saying there's no price too high. And the markets, while high priced and perhaps frothy, don't seem nutty to me. So he says, I can't speak authoritatively about whether we're in a bubble. I just want to lay out the facts as I see them and suggest how you might think about them. And I think that this is a good analysis, and why I like this so much, even though it's long, is that you don't need to know, you don't need someone to tell you whether or not we're in a bubble right now. It's really hard to see that in the moment. It seems obvious in hindsight, but because it's a lot of these psychological factors and not hard and fast numbers for what defines a bubble, it is very hard to say definitively, yes, we are, no, we're not in a bubble. But the framework that he lays out is useful because you can use that and apply that to the current market environment. You can apply that as things progress and move along. Maybe we're not in a bubble right now, but that doesn't mean that we won't be. So anyways, I love this analysis. I love this memo. I love Howard Marks. I think he's fantastic. And I think his memos in general are well worth a read, but especially this one. So I'll try to link to it in the show notes if I remember to do that. And that way you can go to it, but you can easily find it online. It's accessible and available. And I hope you check it out if you want to do a bit of a deeper dive. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.